Hold on, I gotta hit my USB device. Nicotine. All right. All right, man. So let's get into it. So S&P 500, right? I took a long on this trade. So I'm gonna break this down just a little bit more so you guys can see all the different things that I'm putting into this. Let's see how I want to do this. I'll do this in pieces. So I'm gonna do this a little bit more slowed down so you guys can catch on to one, how I'm building my bias. What is my bias? Meaning, what direction am I going to trade in at this time? I had to say that slow. I'm not trying to question you guys' intelligence, but like I said, I do understand most of you have either little to none information about trading. So this is more suited for you guys, but then also for the guys who have a little bit more experience with trading. So just bear with me, guys. So the first thing, like I said, that I'm looking at, this is the trading day. If you follow my cursor, this is the active trading day. This is the active trade that I took. The very first thing that I'm looking at when I come to the desk and I'm looking at a pair, meaning these are my pairs right here. These are my assets that I'm looking to actually risk money on. So when I come to this pair, the very first thing that I'm looking at, don't look at any of this blue stuff. It's this green line. What is this green line? It's the anchor VWAP, or it's called an anchor VWAP. It calculates a specific set of data from candles to basically give me more or less this moving average, or an average of the set of data that it's calculating. I know that sounds very complicated. Trust and believe, I believe the same thing too. But it does all the complicated math for me, so I don't need to be doing this on some huge whiteboard trying to calculate all of this data. This is what I call an indicator or an application. I'm on TradingView, and like I said, I'll be going through what specific ones and how I add my indicators onto my list on a different video. So for right now, like I said, I just want you guys to just listen to how I'm forming my bias and how I'm getting into my trade and how I'm forming these trading ideas. So this anchor VWAP, right? If we go to the daily time frame, I'm setting this moving average that calculates a set of data through a period of time from, what is this, January 2nd, at the beginning of the new year, or at the beginning of the month. What that does for me, it calculates data over a specified period of time, and it gives me this moving average. And the main thing that I'm typically looking at is how is price. What is price? These bars that you guys see, let me zoom in. These bars that you see is price. Price is always actively moving, but these bar candles typically tell me what happened that day during price. This black bar is what I call, or it's not what I call, but it's my bearish candles, meaning that the market went down for that day, right? This white candle is a bullish candle, and it just tells me that the market went up for that day. So I'm gonna go into more specifics, like I said in my beginner videos, but this is more or less the gist for the new guys. So once I have it set to the beginning of this month, don't worry about this month, don't worry about this, I'm gonna just go ahead and delete that. What that then gives me is a direction, or a probable direction, right? So then the next thing that I'm typically looking at are breaks of structure. I know I've talked about breaks of structure before, and more or less, like I said, from my experienced traders, you guys know exactly what I'm talking about. But for the new guys, This is what I mean by breaks of structure. It's typically support or resistance or a swing high or a swing low of price. What I'm typically looking at in correlation with this is how each session has its own price movement, has its own lows, has its own highs. And what I'm typically looking at is for price, this line from this point is more or less like a ceiling. And when you break a ceiling and you get a new ceiling, that sets I just said it, a new ceiling. So this is what I call, or this is what's known as a swing high. Once it breaks this price line where I have it at, that is a break of structure, right? Price moves down and then it comes up and breaks that structure. Like I said, this is for the new guys. So let me go back to the candles. So this is what it looks like with the bar candles up, right? Price action breaks and then it retraces. Let's go ahead and add on my fair value gaps. So for a lot of other traders that have been trading for a long time, you guys already know about ICT's fair value gaps. Like I said before, I do not trade his strategy how he says it's supposed to be traded, but I like the concept and it added more probable cause onto when I get into trades. Nicotine break. Gotta have it. All right, so these gaps in the market, when price is moving up, this is what's known as a bullish fair value gap, or I just call it a bullish gap in the market. The next thing that I'm looking at after I get this break of structure is for price action to fill these gaps in the market. You see this green box. This green box. These are the boxes that I'm looking for price action to hit, or at least for price action to fill. It gives more justification to saying that when price action comes lower, I can get into what is called a discount, right? When you buy something low, you want to sell it high. That's basically what I'm doing here. I'm waiting for price action or these candle bars to move in a certain direction. Once it moves in that certain direction, I'm looking for price to retrace or to move back down to a specific area in time and looking for a specific entry on the 1 minute to trade it low or to get into a position where price is low to sell it high. And I make, well, pretty much all traders make their money on the difference between the point that you get into the market and the point that you want to get out of the market. Make that difference in price. So now, just to circle back again, I get a break of structure. Well, let's start from the rip. I'm bullish because of my anchor VWAP. I get a bullish break of structure. Here, we fill a gap. It comes back down to the anchor VWAP, which is, like I said, another moving average that calculates a set specific data over a period of time. What this does for me, it gives me a more specific range based on the price action of the day. So now what I'm able to do is to look for a discounted price to get into the market and then use my specific entry strategy to get into that market. So let me zoom in again. Break a structure. We fill a gap. It retraces to the anchor VWAP. So at this point, when price hits it, I'm already down on the 1 minute time frame. Now, I know I already posted this on my story, but like I said, this is for the people that's been DMing me, kind of asking me to explain it in a more, I guess, generalized term. This is for you guys. and also for the experienced traders as well. So the next thing that I'm looking at once price action comes down to the anchor VWAP, this pink line that I have, I'm looking for 1 minute divergence. For the people that are new, 1 minute divergence is basically when price, or divergence in general, is when price, in this case, price is moving down. As you can see it doesn't move down in a straight line because price action is non-linear, meaning it doesn't go straight down, it'll move in segments, but still nonetheless still go down. Price action is moving down, and this right here, or this indicator that I'm using, is an RSI. Now, if you look here, let me zoom in a little bit more for you guys. Price action goes oversold, meaning that there were way too many buyers being bearish at that specific time. So the overall relative strength of price was bearish. And at this point, it also goes oversold again. So the main two things, or I guess the main points that I'm looking at is sorry, I had to make sure I had to edit that right quick. But the main 2 points that I'm looking at is for price action to be overbought, and it creates divergence. It's basically moving up. Now, price action, like I said, is non-linear, so it's not going to just move in a straight up line. And also, because this is an indicator, it's not just going to show one straight line going up. It's going to move with the relative strength of price. Like I said, most of you new guys probably don't know this, but this is how I'm seeing it. 1 minute divergence. I know that was long-winded, but just stay with me, guys. The next thing that I'm typically looking at are breaks of structure going in the direction of my bias. So once the 1 minute divergence is seen or drawn or set for most of you guys, whatever terminology you guys use, the next thing I'm looking at is a break of structure going higher. Just like the break of structure that I explained on the 15 minute, this is a swing high, swing low, and on this bar, let me zoom in a little bit more for you guys. On this 1 minute bar, this is where I would have generally got in at. But I believe on MetaTrader, if you look at my IG story, I pretty much got up right around here, like at least like 2 pips away from the entry that I would have liked to get in at. But I was still able to get at least 1 R, meaning I risked 100, and I was able to pull out at least $90, $92 off of that trade once it got to 1 R, basically equidistant from where I would have gotten in at and from my stop loss. And because I had a trailing stop loss, meaning my stop loss, or the point to where in the market where I would have liked to basically get out of the market, I moved that in profits. Let me draw a horizontal line for you guys. Take that off. I'll just draw a line like this. So this is just a visual so you guys can see. I moved this price line in profit. So at that point, what happens is as you can see right here, price action, it moves up and it comes right back down to where I would have gotten in at. Now, if I wouldn't have moved my stop loss in profit, which is another term, like I said, that I'll be going over once I push out content or the actual course material. At this point, it takes me out of the market so that just in case price decides to move lower or against me, I basically don't lose any money.